We cross now to Cape Town, where Eugene Goosen, CIO at Spencer Financial Services, is standing by for our weekly strategy session. Thanks so much, Eugene, for joining us this afternoon. Well, a lot of attention being given to U.S. markets, and looking at some data I've come across very much warranted, where we've got the average correlation between the S&P 500 and the FTSE JSE Top 40 index around 90%. So what are you making of the current debate that's being had on how the U.S. should be stimulated, needs to be stimulated in terms of economic growth?
I think the stimulation that they had over the past couple of months, the QEs helped a little bit, but especially on the asset side, it didn't really flow through to the man in the street and the small company. Now, if you look at the US economy, it is a very broad-based economy, and it's really intensive on the mid and smaller businesses. And that's where the problem lies. The problem is getting the cash through to the guy on the floor. And that has got a lot to do with the capitalization of banks, and then the credit scoring of banks, and then also the willingness of individuals to take up credit. So I think at the end of the day, it still boils back to consumer confidence. And consumer confidence is the way the guy's balance sheet looks. So it brings us back to the QE 1 and 2s that they had. It was more aimed at stabilizing the asset markets, and it achieved it to a reasonable extent. However, especially the equity markets has sold off quite aggressively over the past month or so. And that is going to impact on the consumer side. So it's going to be very difficult. It's a difficult environment. Interest rates will stay low for a substantial period. And I don't know whether additional stimulus is going to do the job. It's simply going to keep the asset prices intact, I would guess.
It's in that very difficult environment that we've got the S&P 500 being labeled cheap. It's been trading at a PE of 12.8, way below the long-term median pricing, and pricing in a huge amount of risk at this stage of the game. The fundamental question would be, in your books, where should fair value lie on a PE basis, and for that market specifically, and let's say over the next year?
Yeah. If we look at the S&P and you look back over history, let's go back to the 50s. The long-term average in the area of 16, 17 times earnings. If we look back over the past 10 or maybe 20 years, the average there around 20 times earnings. Now, if you look at the environment, and I think the two biggest drivers that determine the rating of a company or index is simply looking at what is the interest rate levels and the potential stability thereof, and then what is the inflation market looking like and the potential on that side. So we're actually looking at real interest rates and how real interest rates is going to behave over the next year or two, well, actually over the next 5 to 10 years, because I think structurally we've shifted into a different market environment. So interest rates most probably going to stay very low for extended period. They're probably going to start lifting it towards 2013. And inflation, I really don't see a problem. Actually, we would like to see a little bit of inflation in a market like this, because a rating on a market likes a moderate inflation environment. You don't want hyperinflation, you don't want deflation. So in a low interest environment with reasonable inflation, so you've got stability in your real interest rates, I don't think a sub 15 times PE is realistic. And if we look at forward PEs on the S&P 500, we're dropping to close to 12, or most probably below 12 times earnings. So I think over the next year or two, most probably earnings in the area of 14, possibly 15 times earnings.
So you're looking at a re-rating there of PEs to the upside. Let's bring it back to the correlation that S&P 500 has with the JSE Top 40 specifically, and what that then means for our local market, because to a large extent we've had traders at the desk saying that currently we've got our local market looking fair, if not expensive in some territories.
Yeah, remember we just had or we're going through earnings reporting season. If you look at the current, even historical P's, we're starting to drop below 10 times earnings on the all share already. But that's purely because we had a bit of a sell-off and we are seeing reasonably good earnings coming through. So if we link the S&P 500 to our local market, we're actually linking ourselves to the global environment and acknowledging that a substantial portion of our market is not priced domestically, but it's priced in London and New York. And that is driving the rating. So there are two games at play. On the one side, it's the so-called risk-on-off game, where the market will move out of the emerging universe, but most probably back into treasuries. The second one is on the risk-on side, do they expose themselves to developed markets or emerging markets? I would guess emerging markets is most probably going to be the flavor of the day over the next couple of years because of the economic growth potential that lies there. It's better than in Europe or the US. So I think the rating on the EM market should be a little bit more attractive than what one would expect the rating in the developed markets to be. So in a positive equity market environment, and I think we've sold off way from where we should be, our rating could improve a bit from where it is currently, and it's most probably going to be driven offshore.
Let's take a look at some of the sectors specifically that illustrate what you're saying in terms of PEs and what they're demonstrating, because there are broad discrepancies within our market. If you're looking at the retail sector specifically, we've had that foreign investor interest show itself pretty starkly, and that with the kind of PEs that we're seeing on that front rise substantially, driven by foreign demand, where prices are being compared to emerging market peers. So that illustrating just one extreme. When it comes to the local investor, how do they even begin to evaluate that position and answer the question, what price should we be paying? Is this the right price or not?
Yeah, okay, so what we are looking at here as well is a fear and greed scenario. So as soon as we see a bit of shaking in the market, what happens? The guys tend to move out of the resource counters and straight into the defensive. I mean, we are fairly defensively positioned, but you get to a stage where the P's that you're paying for the defensive stocks, in other words, you're paying for protection, it's like buying an option, is just getting too high. And this is what we're seeing in our market, why people like the defensive plays. They prefer the general retailers, as an example, or Remgro or BAT. And if I look at my ranking list, you slowly but surely those stocks are dropping towards the middle and the lower end of the ranking list, and shares like Anglos and Billiton is trading at extremely low P's. Now, we acknowledge that there's a lot of risk in those stocks and there could be earnings volatility, but you get to a stage that the rating on those stocks are just too low, they're just too cheap. Even if you look at through the cycle valuation, you say we place ROEX on a specific stock, and the stock is going to produce earnings which is most probably still way out of away from the mean, then the valuations are speaking for itself. And I think that's the direction that one should take. Is you should focus on the true valuation metrics and not trying to hedge yourself continuously. There are stages where you do hedge, but when markets get as cheap as we are now, from a foreign perspective and slowly but surely getting in the domestic perspective, you need to get exposure to those markets.
So just to run us through very quickly your exposure then to the resources arena specifically, because you highlighted that you've got a pretty defensive stance at this stage.
Yeah, we are slowly but surely moving out of the defensive stocks back into selected resource stocks. I think the diversified resources are currently priced fairly cheap, Anglos, Billiton. And then we also still like Exxaro, Kumba as examples, and we will build up those positions as the market allows us to, but especially the diversified miners. I mean, if they sub 7 times earnings, I think they're cheap.